So your income statement explains performance. Your cash flow statement explains the movement of cash, whether that be to daily activities, investing activities, or financing activities. Your net flow statement explains position. But most people never see how they all connect together. In this episode, we build the bridge between all three statements and show how one transaction flows through the entire system. So most people look at their finances in disconnected pieces. They check their balance on their bank account, maybe their credit card balance, maybe their investment app, or maybe their paycheck, but they never see the full system. And because of that, financial decisions feel confusing. You can earn more money but feel broke, increase net worth but have no cash, or have positive cash flow while your financial position quietly deteriorates. The reason is simple. You're looking at isolated numbers instead of connected financial statements. Today, we're fixing that. By the end of this video, you'll understand how the income statement works, how the cash flow connects to it, how both flow into net worth, and why every transaction affects multiple parts of the system simultaneously. This is the point where accounting stops feeling like random reports and starts feeling like a complete operating system. Now, over the past 2 seasons and the first part of season 3, we've created the core financial statements, and together they explain your entire financial life, at least in the past. Your income statement measures your income earned, your expenses incurred, and results in profit or loss over a period of time. This answers, how did I perform this month? Next is the cash flow statement. This explains where cash came from and where it went. This answers the broad question of what happened to my cash. In other words, it reconciles the beginning or the end of period cash position from the prior month and the cash position that you currently have at month end. Lastly, we have the net worth statement, or otherwise known as the balance sheet. This shows what you own, what you owe, and your resulting equity. Ultimately, this document answers the question, where do I financially stand right now? Now, most people think these are separate reports, but they're not. They're fully connected. The income statement feeds into cash flow. Cash flow changes your cash balance, and both affect net worth. Everything is linked. Here's the core relationship. The income statement measures economic activity. The cash flow statement measures the cash movement, and the net worth statement measures the accumulated financial position. One explains performance, one explains movement, and one explains position. This is where people usually get confused. You can make money but not increase cash, or you can lose money but temporarily increase cash, because accrual accounting and cash timing are different things, as I've shown through season 1 and season 2. So for example, suppose that you earn a $5,000 salary but haven't been paid yet. Your income statement shows all of the income that has been accrued, but your bank account has not changed. Why? Because income has been earned, but cash hasn't been received. And that creates the accrued wages receivable. Now let's reverse it. Suppose you pay $1,200 for annual insurance. Cash immediately leaves your bank account, but economically you haven't used all the insurance yet. So the income statement does not immediately show the full expense. Part becomes a prepaid asset and part becomes expense over time. Again, cash timing and economic reality differ. The cash flow statement exists to reconcile these differences. It starts with net income and it adjusts for timing differences. That's why depreciation gets added back, accrued liabilities are adjusted, prepaid expenses are adjusted, receivables are adjusted, and the cash flow statement translates the economic performance into the actual cash movement. Now let's connect all three statements together using one transaction. We'll use the example of the car loan payment. You see this on your bank statement, car loan payment for $450. Most people think expense, but the system is more complex than that. That payment actually splits into interest expense, loan principal reduction, and cash outflow. Each affects a different statement. So step one, the income statement. Only the interest portion is an expense. Suppose $80 is interest and $350 is principal reduction. The income statement only records $80 of interest expense. Step two, the cash flow statement. The full $450 reduces cash. Cash doesn't care about accounting classifications. Cash simply left the account. Step three, the net worth statement. The loan balance decreases by $370. That improves liabilities. Cash also decreased, so one asset fell, one liability fell. Net worth changes only by the interest expense account. So once you understand this system, financial confusion starts disappearing. You stop asking, where did my money go? Because now you can trace it. You understand why net income differs from cash, primarily due to timing differences, why debt payments are not fully expenses, why timing matters, and how all financial statements reconcile together. This is the exact same system businesses use. You're simply applying it to personal finance. So here's the big takeaway. The income statement explains how value was created or consumed. The cash flow statement explains where cash moved. And the net worth statement explains where you financially stand. And together, they tell the complete story. Once these three statements connect in your mind, you stop reacting to money emotionally and start analyzing your life like a financial system. So now you can finally see the full system. Your income statement explains performance. The ending value, net income, becomes the beginning value in your cash flow statement. Your cash flow statement explains movement of cash and directionally into the three buckets of daily activities, investing and financing activities. That ending cash value ends up in your net worth statement as the ending value of your cash. And your net worth statement explains your financial position. And every transaction flows through all three simultaneously. This is the foundation modern accounting and finance are built on. Most people only look at isolated numbers, bank balances, debt balances, paychecks, investment accounts. But once you connect the statements together, you stop looking at money as disconnected events and start seeing a complete financial system. And that changes everything, because in the next section of this series, we begin moving from recording reality, which is what we've done up to this point, to analyzing reality. We'll start breaking down spending behavior, financial strength, cash usage, risk, leverage, and the signals hidden inside your own financial statements. Because building the system was only the beginning, now we learn how to read it.